was struggling to find insurance protection for a rather high-risk business. Back then it was Youngstown Sheet and Tube, and that insurance consultant struggled to find insurance for one of their higher risk divisions, which was a mining division. And the mining division, by definition, this sort of mining exercise was called captive mining. So ultimately, that's where the term captive started from, was the insurance coverage that covered the services of the workers that worked in a captive mine. And for the history buffs out there, a captive mine, which I never knew what it was until recently, was when the corporation doesn't unearth the material to be sold to the free market. It unearths the material for its own use and for its own manufacturing process. And that's much like what a captive is. A captive is a regulated insurance business, and that insurance business is only permitted to write policies of insurance to the business for which it is owned by. So simply put, if I own a business and I own or participate in a captive insurance company, that captive can only insure my corporation's risks. My captive cannot go out to the public and say, hey, Wayne, I'll insure your homeowner's insurance. Or Sally, I can insure your car insurance as a captive. I can't do that. So the captive can only insure the risks of the affiliated business. And that's an important topic to think about, because one thinks that, oh, an insurance company can write any different risks, so multiple risks, but really a captive has a narrow focus. The employee benefits captive has a very narrow focus on what's called medical stop loss, which we'll talk about in a couple minutes. But a captive has two domicile options. It can be an onshore option, or it could be an offshore option. The medTRANS captive that we are managers of, it's an onshore captive, and it's domiciled out of the state of Nevada. So what does that actually mean? Well, it doesn't mean very much at all. It just means that Nevada has a set of captive statutes, and our captive subscribes and adheres to the Nevada statutes. And in the IRS's eyes, in the Fed's eyes, we're just a regular C corporation that files a tax return every year, and we just go about our business just as a general C corporation is. The other option is an offshore option, and that offshore option is identical to the attributes of an onshore, except it's in Bermuda or the Cayman Islands or in Ireland or Barbados. There's a handful of other offshore corporations or offshore domiciles that you can pick from. And quite frankly, nowadays, there's no one better option than the other. Each one has its favored attributes and disfavored attributes. But as an onshore captive, one of the stickling points is the board of directors of the captive must meet in Nevada at least once a year. That's a very common attribute for any captive domicile, where they want the captive owners to come onto their soil and have a corporate governance board meeting. And then within that onshore-offshore option, you have two more options. You have what's called a single parent captive, which can't get any simpler than that term, really. And that's where a business is the sole owner of a captive insurance company. And that business can lay the foundation, the governance of how their captive is going to be organized and governed. And then you have a group captive, which is the more common option. And the group captive can be cloaked in a various different structures. Commonly, it's mutually owned by the participating or subscribing businesses. Wayne, you're a member of the Catalyst captive, and that's a member-owned mutual captive. okay? Some captives are owned by the captive manager. Some captives are owned by the insurance company, or even an insurance broker can own a captive insurance company. Again, when you see one captive, you've seen one captive, and there's a lot of options out there that you need to vet out and see what fits your organizational culture. So within employee benefits, you really have what's called the funding of your employee benefits. Now, the health plan, I'm going to be referring to this quite often. There are two distinguishable options for an employer to fund the fringe benefits of employee health insurance. And that is inclusive of medical, prescription, sometimes dental, sometimes vision, okay? The two methods are fully insured and self-funded. The fully insured, believe it or not, is the less common method for an employee to get medical insurance. Less than 40% of the non-Medicare eligible employees are buying from a fully insured product. Said another way, 60% of the Americans that are not Medicare eligible and not Medicaid eligible are within a self-funded health plan. So the primary difference is this. A fully insured health plan is where the employer pays the carrier a monthly check, and they let the carrier do all of the dirty work. The carrier pays all the doctors, the carrier pays the prescription costs, and really what's happening is a Blue Cross is pre-negotiating a reimbursement schedule between the health plan and the facility and the doctors. It's really a hands-off approach. The employer simply pays a premium and gets a service. A self-funded funding method is a much more engaging method. It puts the employer in more of a driver's seat than having someone pay their claims on their behalf. So what I like to say is a self-funded plan is a pay-as-you-go. When your employees go to the doctor's office, it's a $60 bill, thereabouts. When your employees get a Z-Pack from the pharmacy, it's $6. My preference is I would rather pay that $60 when it incurs as compared to paying a carrier $10,000 a month and then having the carrier pay $60. I want to do more with my cash. And when you're in a self-funded plan, the employer holds on to their cash for a longer period of time. And when the employer holds on to their cash, it's the purest method. You escape and you are in control of the claims payment process. Now, what employers should be thinking is, well, geez, why isn't everyone in a self-funded model? Well, there's some cash flow risk there, right? It's easy to pay for a $60 doctor's office visit or a $6 Z-Pack, but geez, what if my employee has cancer? Or what if my employee is in a major car crash and it's $1 million? Well, that's where the cap comes in. The captive serves as a backstop. It takes the really expensive risk off of the employer's plate and it passes it to another entity, okay? So we'll talk about that in a couple seconds.
Phil, is there a smaller, larger that normally goes either way? Just wanting to get this a little more interactive here. Is it that smaller groups are the ones that are doing the fully insured in your example there? Larger groups are doing the self-funded?
Yes, Wayne, generally speaking, employers with 50 or more consider the self-funded option as a viable solution. Employers at 100, 150, 200 or more really make that the solution that fits the best, right? So it makes sense for an employer above 100 to go self-funded, and it really, for 50 employees and about that, it makes sense to consider it. that make sense?
And those of us that made that jump, oh gosh, a long time ago, it just becomes so second nature to be a self-funded plan, and it gives you a lot of flexibility, particularly when you're looking at expenses and coverages and things like that. And I know you go into a little more creativity here as we get further into the slides. I just wanted to get us to give a little more banter here.
Yeah, so 50 and above, it's worth your time to vet it out. 100 and above, you should be doing it. It's a whole lot more reasonable. So in the big picture, my health plan, if I'm an ambulance company, I have my health plan, and my health plan attributes fit my culture. For example, when I buy fully insured, my broker presents to me 5 different plan design options: $25 copay, $500 deductible, $1,000 max out of pocket. That's perfectly fine. Very simple way to buy insurance. However, maybe your culture, maybe you want a $27.50 copay. You really can't do that in the fully insured because they've got their plans already mapped out. When you're self-funded, you have that option. So my health plan is designed based on my needs and my corporation's needs. And then I kind of layer in a wellness plan. And the wellness plan is tailored to whatever you want. They're all over the place. They range in complexity and, employee engagement and so on, okay? The health plan is where most of your money is. It's where most of your claims are. The captive, the corporation, the C Corp, the captive, that is ours. That's all of the members. They participate in it. They own it. And on a monthly basis, you're paying a little bit of premium into your captive, and that premium sits there until someone has a claim. So what does a claim look like? Very similar schematic, but on a granular level. If I'm an employer, I'm going to have within my stop loss policy what's called a specific deductible. It's like a specific retention. And what that says is for every belly button that's on my health plan, I'm responsible to pay up to X. Now, in this case, I'm indicating $50,000. If you're a smaller employer, say with 30 lives, maybe that's $25,000. If you're a large employer with several thousand employees, maybe that $50,000 is $200 for you, okay? The point being is the employer can budget up to your specific deductible. And then when an employee spends more than their specific deductible, it becomes the captive's shared layer of responsibility. And the captive layer is shared with all the members in a much less frequency than in your health plan. So as you see, 70 to 80% of your budget resides in your health plan. 10 to 15% resides within the captive, which is ours, okay? And then we always hear this story. I love the captive, Phil, but what happens when I get hit with that $1 million claim? And my short answer is bring it on, because we have layers. The layer is anything above 300,000 goes out to an excess reinsurance carrier, and medTRANS pays an excess premium for that, just like every captive out there. No captive, no insurance company holds all of the risk. Every insurance company buys some level of excess reinsurance. We're no different. Okay?
And this concept of our costs, your costs, and their costs is something that you get into. And once you understand it and accept it, it's actually not that hard. This first time seeing these slides, it can get confusing, but once you get through this, like you said, Phil, the specific deductible changes over time with your size. We've moved from a 25 to a 35 to a 75 as we've grown. So it's just a matter of your level of comfort, budgeting ability, and really, the higher that number is, the more chance you have at making money or
Yeah,
retaining, having it cost you less in the long run. It's
that's right.
counterintuitive when you first look at it.
That's right. So this is what I've turned into, an underwriting nerd, and some of the people will find this interesting, but I find this fascinating. This chart right here is the gospel on how to predict medical stop loss costs. So what most people don't realize is the 80-20 rule is very applicable here in health insurance. 20% of your population, simply put, is going to spend 80% of the budget. Okay? So employers come to me and say, I can't control medical expenses. I have 300 employees. How in the world can I, mitigate 300 employees' risks? Well, you're not. You're only mitigating roughly 60, because those 60 are your high cost drivers. Okay? The other 80% are spending virtually nothing. A $5,000 bill is really one emergency department visit, right? So ask yourself, you're paying fully insured premiums, and they're paying these doctors and the facilities, and 20% of your population is driving the cost. So this is very.
Phil, by the look on your face, I think we lost your audio. I am not able to hear Phil. I don't know. Amanda, can you hear Phil?
I cannot hear Phil, which is why it's so great that you're on on the line to give the rest of this webinar, Wayne. We appreciate you. I'm glad we stopped on this math part.
It's a little deeper than I go, but I'll tell you that this healthcare usage is something that we saw in our plan very early on. We did have a couple of very high expenditures that were reined in the following year. And Phil is back. I think I hear him.
Welcome back, Phil. Wayne has given us a bunch of misinformation for you to correct.
Okay. Can you guys hear me now?
Yes, you sound great.
Oh my goodness gracious.
Thank you.
This technology. Sorry about that. So what happened in this, what we do is we assign buckets of risk and severity buckets. And as you can see, the first bucket, the average cost is about $12,000. And we know that the frequency of that occurring is roughly 10%. So we can see that 98 people out of 1,000 are going to spend $12,000. Why this is important is because this continuance table has been time tested. And this is a very good prediction of a group of employees that we can safely assume what your risk is going to be over the course of the year. Now, I put this 15% spend bracket here, and we're going to talk about this in a second. When you're in a self-funded plan, you see where all of your dollars go. So if we can accurately attack some of this, $69,000 claims usage, that falls right to your bottom line. And that's what's exciting about being in a self-funded plan. So I added this slide just to paint a picture of when you're in a fully insured program, the Affordable Care Act implemented what's called the minimum loss ratio. And this is not very favorable to employers, because what this says is for every dollar collected, the insurance carrier has to pay between 80 and 85% of that dollar towards medical claims. The other 15 or 20% is reserved for administration. And administration is the profit. There's profit in that for the carrier. If during the calendar year, a Blue Cross spends less than 80 or 85% on medical claims, they have to give that back to the employer. And then the employer has to distribute that back to the employees. So the carrier is not in the business of giving money back. So what does that mean? That means that the carrier would be shooting themselves in the foot, profitability-wise, if they actually lowered your premium, right? So they're never going to do that. And if they do it, they're not lowering it at the clip that you can with a self-funded product. And I don't want to get granular or in the weeds on this, but it's just not in the favor of the employer. So here's the way it works. Let's assume that your budget is $1 million for health insurance. So what that means is you're paying the fully insured carrier $83,000 a month. And what you don't know is are your employees spending 80, 90, or 50,000 a month? We just don't know that because they necessarily won't tell you. If your employees spend 750, then the carrier wins because you overpaid them by 250,000. If your employees spend 1.2, then you win because you've only paid them $1 million. But what happens at renewal? They're going to attempt to call that back. So when you go into a self-funded plan, you are now the payer of the medical claims, and it's just a purer transaction. In other words, if your employees only spend $750, then your organization is only paying $750. So that looks like this. Your budget's still $1 million, but you're going to have between 70 and 80% of that million go towards medical and prescription. And those are what's called variable costs. So every month, you're going to have maybe 10,000 of claims, 20,000 of claims, 15,000 of claims, 12,000, and so forth. You're going to have varying monthly claims. But you're also going to have a fixed amount, which is administration's about 10%, and then stop loss premium and the cost of the insurance of the stop loss is roughly 10 to 20%. And that 10 to 20% is what goes into the captive. So I'm going to pause right there before I get into more numbers. Any questions?
We have a couple of great questions, actually. The first one is from Will. With captives, do you still have in-network and out-of-network? Especially, say, dealing with physicians like radiologists that are generally out-of-network. If out-of-network, is the insured exposed to balance billing?
That's a good question. So the health plan, not the captive. Now, the captive is sort of like an overarching just program. The health plan will contract with a managed care provider, what we call a BUCA, a Blue Cross, United, Cigna, or Aetna, or maybe a local network. So yes, you will have in-network and out-of-network doctors and facilities just like you do today. Your employees don't know anything behind the scenes when you join the captive.
And I'll say that we here in Milwaukee, we've used a network that's specific to Wisconsin that has worked well for us for our self-funded insurance plan, even prior to joining the medTRANS captive. And I think this dovetails really well into Scott's question that we have in the Q&A. How do I negotiate the rates that I'll pay for employees' health expenses? For example, Oxford would certainly pay less than I would. And that's this network that Phil and I have just talked about. We at Bell selected a local network, but we could just as easily have used United Healthcare's network or Blue Cross's network. And I think that's a correct way of putting that. I know you have some other networks available as well.
That's right. And what we generally find is the BUCAs, Blue Cross, United, Cigna, Aetna, their discounts will vary based on the geography that you're in. But generally, the delta between all of them are about the same. You know, The Blue Cross may have a deeper discount than a United, but it's only by 5, 7, 3%. It's not that much of a difference. Okay, so the health plan will be able to rent a managed care network, and let's say you're renting the United network. Your employees think you have United insurance. They will go to a United website, look for an in-network or an out-of-network facility or doctor. Any other questions?
I think that's it for now, but as a friendly reminder, everyone, you can use the double speech bubble Q&A function to ask questions, and we will read them out loud to Phil and Wayne at our next pause.
So this part blows my mind. I like to keep things simple. In healthcare is like produce. When tomatoes are in season, they're very inexpensive and they taste really good. But when they're out of season, they don't taste very good and they're very expensive. So just keep that in the back of your mind here for a second. So in this example, on the left side of the screen, you have just a very simple cash flow illustration for a fully insured employer. In this example, year number 1, the employer is billed by the carrier $1 million of premium, and the employees spend $950,000. So that means the employer overspent by 50 grand. And you can go down on each one of the five rows as you see fit. In the self-funded employer, if the employer is budgeting for $1 million and the employee spent $950,000, that net column, that's what the employer keeps. That $50,000 never leaves their corporation, because a self-funded plan is pay as you go. Pay as you go. In the fully insured, you're prepaid for something that may or may not develop. So why this is important is over time, this becomes a big deal. So in the first illustration, this is not unusual. Year number 3, the carrier increased your rates because you had a bad year. You paid $1 million, $1.1 million, and your employees spent 1.2. So you overspent by 100,000. So the insurance carrier tries to claw back some of that lost profit, right? So now that's why your rates jumped up pretty high in year number 3. In the self-funded plan, same scenario, but when you're self-funded, there's no clawback, right? If that claim was caused by, a high-risk trauma or something happened, if you're clawing back money from a lost year, who were you clawing it back from? You're just clawing it back from yourself. So it's a different mindset, and that's what I'm trying to portray here. So you go one step further and you say, well, geez, in the first year, my employee spent $950,000. And Phil, what you're saying is, if my employees only spent $900,000, that means $100,000 never leaves my corporation. And yes, that's right. So how do we achieve that? So cost and quality, the tomatoes, the produce question. These are actual facilities in the Tampa Bay region. And this is the paid differences for some of these services. Cataract outpatient surgery. There's 46 facilities in the Tampa Bay region, and the delta between the lowest and the highest is $3,000 plus, right? So if you can encourage and you can find, maybe not the $978 provider, but maybe you find a provider that does it for $1,500 or $2,000, that's an immediate $2,000 that you could save, right? So this is part of finding the right care, the cost and quality of healthcare. Believe it or not, healthcare The more a doctor does a procedure, the less it costs the employer. And it's counterintuitive. In this example, Kansas City, total knee replacement. The ranges between 50 and 20,000. Well, I'm not saying that the employee should go to the $20,000 procedure, but I know for sure that the $50,000 location is not any better than the $33,000 one. Imagine if you could save $18,000 or $17,000 on one transaction, right? That $17,000 would fall immediately to your profit. So we look at these reports and we say, how do we steer, how do we educate the employees to make a conscious buying decision of healthcare? I'm telling you now, the employees have no idea about this. And it's an immediate savings to the employer if the engaged employer can bring the education to the employee, right? So then we take one step further. North Kansas City Hospital, same facility. These are all admitting doctors that can do a knee surgery. Now, I'm not saying do it with the doctor for $23,000, and I'm certainly not telling you to do it for $43,000. But look, the delta is pretty wide. So what we know is the doctor who sees 500 knee surgeries in a year can do it more efficiently and time effectively than a doctor who only does 50 knees a year, right? Because the hospital stay is shortened with the doctor who does 500. He or she has seen every complication from a typical knee surgery, so the OR time is shortened. So these are incremental wins that a self-funded employer can implement and have an immediate dollar savings. Now, my last slide before I take a small little break. The quality of physicians in an open heart procedure. You want to find a doctor that Dr. A, B, or C, I would be delighted to have him or her do my open heart surgery. You certainly don't want to do it with physician H, AKA Dr. Death, right? So the mortality and the complication index are important factors. So what we do is when we discover a prior authorization request for open heart surgery, assuming that it's not urgent, that you didn't go to the ED and you need open heart surgery in 2 hours. But if it's a scheduled open heart, we want your employees to get a second opinion. We want to empower them to say, hey, you're seeing Dr. F. Maybe Dr. F isn't the best option. Let me make you an appointment with Dr. A, B, or C. And if we do that, we'll waive the copay. Let's get you a second opinion, right? So these are all things that employers don't see if you're fully insured. And if you're self-funded, you can dive into this granular activity. And that's what's exciting. So in this slide, if we can save $50,000 simply by going to the right doctor, right facility, that's an immediate savings to the employer's bottom line. Because that $100,000 has never left the corporation, because self-funded is pay as you go. Okay? So now you say, well, show me proof. And the Surgery Center of Oklahoma, there's no affiliation. We don't encourage people to go here. These types of surgical centers are popping up all over the place. These are cash businesses. And what the Surgery Center of Oklahoma does is they list all of the prices of all of the procedures. And in this example, a knee replacement is $15,500. So an employee can go to this facility, and on Thursday, the third Thursday of the month, they do leaves all day on that Thursday, and it costs 15 grand, as compared to the hospital facility, which is 33, and the doctor who did the procedure, which is what, 25, 30,000. So a $60,000 knee, you can get it for 15 grand. So those are just the examples of when you get granular, you can get some cost savings opportunities. I'm going to pause there because I'm going to change directions from here.
So Phil, what I'm hearing you say is when you're more involved, you can really have some savings here. It's not required to be involved, but you're reducing the ability to have savings if you're not involved. This is something we learned when we went to a self-funded plan many years ago, that you can help your employees understand there are better options. And that can have a significant financial impact to our expense on our health plan. I do see we do have a couple of questions here if we want to address them while we're at this break, Phil.
Yes.
David asked do we work through a local insurance agent or do we work directly with you as the captive? I can let you answer that and then I can add my experience on that one.
You are free to use your trusted advisor. That trusted advisor can be an insurance consultant. I don't use broker, your health plan consultant. If your consultant is a CPA or an attorney, you can use your trusted advisor. Right?
So what I'll say about this is when we first came into medTRANS, it was a hard thing to understand where they really fit in the puzzle. Since medTRANS is really the reinsurance or the safety net on my self-funded plan, the captive was an invisible transition to our employees. When we made a change, I think we were with AIG the year before coming into you, none of our employees knew. So there were options for us. We could change our advisor if we felt our current advisor wasn't appropriate. And there are options available to look at, but we just changed out the stop loss carrier in the background. None of our employees knew we made a change from what we had the year before. David does continue with a second question, Phil. Does your program include health? Does it include pharmacy, vision, dental?
Yes. Now, the captive, the captive has a solution for dental and vision, but they're not kind of part of the captive. The medical and the prescription are integral part of the captive insurance program.
And David, I'll tell you, we had a lot of these questions when we first started going with our self-funded plan. Self-funded plan is really a puzzle. What pieces do you want? There are so many changes that we could make. It was very difficult in our initial transition, and this was years before medTRANS. We were actually moving from United Healthcare to a self-funded plan. And when they were going down, we would have questions about this coverage or that coverage. And when the answer kept being, well, what do you want it? Is so different than in the fully insured market, where the fully insured market, you have to buy the book that's already been made, and that's what coverage you offer your employees. Where with a self-funded plan, it's a recipe. You design what you want. And then medTRANS would sit, or another insurance captive would sit behind that. And Pete is asking us, are the yearly savings redistributed to the captive members?
Very good question. 100%, unequivocally, yes. With 100% of the earnings from the captive flow back to the members of the captive.
But you also have to take into account that's not immediately back. There are insurance workings that it takes a little while to get back, but it does come back. It is yours.
Yep. So what makes us kind of unique is you would get financial statements every quarter with us, and you will be able to see the retained earnings and the equity build up within you. Did I go?
Yep, that's the end of
Okay.
our current questions here, Phil.
Good deal.
Sorry.
So I get the question a lot of what's the common bond amongst the members? And I have these all mapped out, but I'm going to summarize it into one simple statement. You need to subscribe to the culture of the captive, which means some captives have different cultures. Put another way, you have to participate in the insurance company that you are involved in. This is a participation sport. Now, it doesn't require a full-time employee to manage it. I'm not asking Wayne to submit 2 or 3 hours a week to work with this, but you have to be frustrated about some of the current ways on health insurance that's deployed. That's the first point. But you also have to have an understanding of the captive. I don't want, nor does Wayne as a participant, we don't want your check every month. We want your check and we want your participation, because that recipe is a winning recipe. Okay.
And clearly being active is what's going to get you savings by being involved. This one being health plan, for us, we have to be involved in what we know of our employees, how we can steer them and help them. My other captive, it's all about safety. What can we do for employee safety and vehicle safety? So there are distinct cultures in these. And it's actually pretty fun because it's a networking environment where you can talk to your peers and see how do they handle these situations? What can we do to improve our business? Because as Phil was saying with you see one captive, you've seen one captive, we all know that applies to EMS agencies. The way ambulance operates in the 911 system in Milwaukee is different than it is in Madison or Tampa or anywhere else. So we're familiar with this from our EMS perspective. Now let's do it on our health insurance side. They're all different.
And that bottom bullet point is collaboration. Sometimes we get members who say, that ambulance company is in your captive, I want nothing to do with them. That's not really the culture that we want you to subscribe to, because when collaboration happens, everybody wins. This is a fraternity, and we want everyone to benefit from it. Okay? Now, what I didn't say is, if you don't have, 20 for us is the minimum, but if you have 25 employees, you might be eligible. If you subscribe to the motivation to get involved, if you have 20 employees, let's have a discussion. If you've got 2,000 employees and you're already self-funded, man, that's a no-brainer. You're buying stop loss from someone. Would you rather have your captive be the stop loss company? Would you rather enrich a carrier or enrich your own business? That's a simple no-brainer. A lot of times the employer will say, I've been told by my broker or by the carrier that I've got bad risk, and that's why I earn 30% rate increases every year. Maybe, but we just don't know, right? What you don't know, you can't measure. And when you go self-funded, you'll be able to measure. And that's one of the finer attributes of the program. And then, as I just mentioned, you don't need to have a dedicated full-time person to run this program. In fact, your HR department will find value in seeing the claims out there, because you're gonna have an instance where you say, oh, wait a minute, Sally should have been off of our plan last month. Why is she getting medical coverage today? When you see that, you can stop it, okay? So the culture of the captive is very important, and it's very important for most captives out there as well. And I'm sure Wayne can attest to that.
Yeah, being participating in the captive dialogue and working with your peers, it's a great networking environment, and they have similar goals. Why reinvent the wheel? Talk to your peers.
I'm going to pass through these other slides and kind of land on these last two because we're running out of time. this whole COVID-19 thing is killing the businesses, but on the health plan side, no one's seeing the doctors, no one's going into surgeries, no one's doing outpatient. So medTRANS, our captive ecosystem, the members are seeing about a 50% reduction in claims. So those groups that just came on for 1/1 of 20, they're experiencing tremendous reduction of cost. On the flip side, the carriers that are insuring the fully insured programs, they're sitting on mountains of your cash, mountains of it. So it's a very interesting dialogue. I don't want to go down this rabbit hole because I'll get all frustrated, but nonetheless, I put down our average cost over the 10 years. And as you can see, in 2010, we had what's called a PEPM average cost of $609. That was the cost of the employer to administer health care to their employees. Here in 2020, we're at $260. Our members are winning this game, and much of that is COVID. I don't pretend to take advantage or to be the reason for that, but self-funded plans are winning this year, and it's because of COVID. We're not seeing the high-cost ICU claims that we thought we were going to see early in the year. So I'm going to take this as the last slide. I want to be respectful of everyone's time, but I'm a captive manager, and I manage several verticals, with medTRANS being one of them for ambulance companies. We have annual membership meetings, and they're always at the last, week or so of March. If you're interested and you're not ready yet, you're welcome to join the annual meeting next year in Savannah and the year after in Jackson Hole, Wyoming. Shake the hands, ask the questions, learn about the program, come join us, and I think your opinion of what a captive can do will change drastically when you hear it from other people like me. I'm going to pause there, answer questions.
And I'll say that Phil, from your programs that I saw we were supposed to do this March before COVID canceled them, you do know how to have an engaging membership meeting in some really great locations. I haven't looked at where these two hotels or looked in the details too much. The little bit, it looks like it will be a fun time. And I'll tell you that when you participate in an offshore captive, you get some rather interesting locations because offshore is required to be outside of the United States for those meetings. I don't see any questions in our Q&A. If you have any questions, please use the double chat bubble Q&A and put your question in so that Phil or I can address them.
We do have, it's Amanda, we do have one question in the chat box and one question via text message. So the first one is from Will, who would like to know, can you add other benefits as a bundle to help with the out-of-pocket costs? For example, telemedicine, gap plans, etc.
So those, like a telemedicine is part of your health plan fringe benefits schedule. So all of our members have a teledoc-like option as part of their plan. A gap policy. So to me, that means like if your deductible is $5,000, there's like a gap insurance that you can offer for that. What we say is, you're an insurance company now. Give that money to your captive. So what I would say is reduce your deductible to something like $1,000, and now you can save that premium dollars that you would otherwise pay to the gap.
Wonderful. And then another question that people have, somebody texted me is, how do you avoid any HR issues when coaching your employees to go with a less expensive doctor or procedure?
Great question. You can't make the decision on behalf of your employees on where they need to go. So in other words, You can point them to that doctor over there, which is proven to be a better option, but it's ultimately up to the employee to go to that one who may be more expensive. So what you do is you incentivize them. You say, I'll make the arrangements to get a second opinion over to that doctor because we think it's better. And if you do, we'll waive your copay. Or we'll waive your deductible if you go to this hospital, because we know that your $1,000 deductible, that hospital over there is going to cost 20 grand, and that one's going to cost 8. So the employer absorbing that deductible for the employee is a big incentive, and we could do that all day long.
Thank you so much for sharing that. So would you recommend that a limited number of your employees or any specific role or person be in charge of reviewing your employees' medical expenses? Have you ever experienced any confidentiality issues, or do you help employers navigate some of those challenges?
Wayne, would you mind answering that?
Well, the way that I'd address that is once you get into a self-funded plan, you do have access to confidential information. So you have to have internal controls on how do we deal with the ability to see confidential information. And this comes about as being a self-funded plan, not necessarily a captive member. As we get into the captive, that's where we've relied on our trusted advisors to do more of the review and the advice of who or what we should be looking at. And we have, in our organization, because of our size and our HR's size or lack thereof, we have tried to limit the PHI that comes into our organization. So we rely on our advisors for this. And there are times that just from HR talking to people and questions about insurance, you're going to figure out what's going on, and the employee may not tell you. You have to deal with that. Even if you're fully insured, you can figure out what's going on. You have to deal with the confidentiality and deal with it respectfully. So as Phil had said, you can make recommendations, you can make nudges, and you just incentivize. When you see you can save $10,000 by them going here instead of there, waive their deductible. We'll pay your deductible for you. It's to your benefit. So yes, you have access to information. You have to make internal controls to deal with that.
Thank you so much. That's super helpful. We have 2 more quick questions in the queue. Pete would like to know, if you have time, can you answer whether there are tax benefits to being part of a captive?
Oh man, am I blushing? Yes, there are. Some captives have different tax advantages. Our captive does have some measurable tax motivation or tax savings that can be had. We're talking high, this is college level risk financing. What you asked is graduate level tax planning and risk financing.
This was a lot of conversation you and I had, Phil, and both of us are numbers guys and enjoyed it. That could be a session unto itself for the tax benefits and calculating what your tax benefits are.
Yes.
Isn't that a fair way to sum it up and go, sorry to punt that question? They're
Yes.
there, but it's really hard to get into what will they be in specific situations.
You can call me. I'll be happy to share with you.
Perfect. And then Anne, I think, must be intrigued because she wants to know, do you offer captive options for professional liability and or workers' comp as well?
So medTRANS could do that, but medTRANS does not do that. We've got a very exceptional working relationship with Catalyst. We have a lot of members that are in both captives. We choose, just as Catalyst chooses not to offer health, we don't do any property captive.
So here you asked, and you specifically asked for professional liability and workers' comp. Workers' comp is offered in Catalyst along with the vehicular liability. but professional liability is not part of Catalyst. It was looked at and was not picked up because of complexities to get that across multiple members. So the work comp, please talk to us about Catalyst. I'd love to talk to you about that. We've had a very good experience there. And the professional liability, that one is, we're not, Bell is not in a captive for professional liability at this point.
So Amanda, I'm sensitive on the hour. I'd like to just make one closing statement that even though this is graduate level captive insurance, no one should be fearful of losing their shirt, going bankrupt. The insurance is there for a reason. And I say that because we have to take the mindset of, if you're in the fully insured and you're paying $1 million, that's gone. In a captive, you could pay $1 million and it's gone, or maybe you could have a little bit of an upside. But no matter what you do, you're never going to win the game unless you're in control.
Thank you so much for those insights, Phil and Wayne. As you mentioned, we're right at the top of the hour. I did want to assure the folks that are asking that we will include a recording of this session in tomorrow's Daily Digest. We also have included a link to the slides in the chat here, and the link to the slides will also be included in tomorrow's Daily Digest. So the recording and slides will be available to everyone who attended this session. Phil's contact information is here, listed on your screen, and we truly appreciate everyone's time and thought today. Thank you, Phil. Thank you, Wayne, and thank you to the 27 people that, even though we're overtime here, are still on the line with us. So I think this was a phenomenal session, and we look forward to hearing many more success stories of our members in captive insurances of various kinds. So thanks again, everyone, and have a wonderful afternoon.
Thank you, Amanda. Thank you, Wayne.
Thank you.
Bye now.
Bye.